Hello, stock investors. Welcome to my weekend live stream covering stocks, looking at how we can find the next stock that is going to be a winner for the next couple of years. I'm Victor, and I'm a long term investor in stocks looking to grow my net worth by buying the right companies, holding those stocks, and seeing those stocks go up in value. I like using fundamental analysis on stocks, valuing companies based on the future cash flows they're going to deliver, as well as the profits they're going to generate, and seeing what the intrinsic value is of those stocks, seeing if it's an opportunity to buy a stock when the company or the market maybe doesn't believe in that company, maybe just doesn't understand that company. I could buy at a discount and see my investment go up. So I'll be looking at some stocks. I had a list that I had in mind. I've got one request coming into the stream from a member of the channel, and I'll be covering that stock in a bit. If you would like me to look at a stock, be happy to. If you're a member, just pop it in the chat. If you're not a member, you can become a member on the fly, or you can just buy a $5 super chat. I'd be happy to look at your stock. So just to get going, last week was a fairly volatile week. We ended the week trading lower. The S&P was down about 1%. Now that's not a big deal considering that the S&P is up for 2025. It did show some signs of a lot of volatility, showing that there is some caution in the market where investors are seeing these high stock prices and maybe saying, hey, stock market's a little too expensive. Let me go ahead and cash in a gain on a stock and move on. There's a variety of reasons, but the reality is that I think we're going into next week with more concerns and a little more fear than before. So we might see some of this volatility stick around and take the market lower. Year to date, the S&P is up 14.5%, and it's been flourishing for 3 years, really. So the appreciation rally is on. Stocks are a great place to invest your money and see that money grow, see that capital grow. And I am really glad that I've spent a lot of time on stocks for a number of years, because the last 3 years have just been phenomenal for my overall gains and performance. So that is the market. Taking a look at some individual stocks. On Friday, we had NVIDIA rally, and that's after having a couple of rough days. If we look at, I'm going to look at the 1 day, and I'm going to look at the 1 week heat map. So we had some stocks in technology, semiconductor rally on Friday. Google had a rough couple of days. So did Meta. Meta had a rough week. Meta's had a rough time since their earnings. It's been tough. Amazon had a tough week. The banks, for some reason, sold off. Some healthcare stocks sold off as well on Friday. When we look at the 1 week, Amazon had a tough week. Tesla had a tough week. Some computer hardware and semiconductor related stocks had a tough week. Meta, Palantir had a tough week. Industrials had a little bit of a red week. Energy did have a good week, and some healthcare stocks really had a terrific week. So these healthcare insurance companies, the pharmas, they're beginning to work, which is interesting. So that's what's happening from a heat map perspective. The big caps, that it seems like every ETF is going to own these, and a lot of investors own these stocks. NVIDIA had a tough week, but they're still a $4.6 trillion market cap company. Year to date, they're up 41%. Apple's been somewhat stable. They were only down 0.2%. They're up almost 9% for the year. Microsoft up 21%. Google up 46% for the year. Amazon up 7%. Broadcom up 47.7%. And Broadcom moved ahead of Meta in the ranking of most valuable company. And Meta's been really falling ever since Meta announced their earnings and they showed that they were spending a lot of capital without having much to show for it. The market's really been selling off that stock. So Meta's under pressure. Tesla is flat. TSM is up 44%. And then Berkshire announced their, or I should say, released their investor letter. They announced some news. The big news was Berkshire Hathaway's buying into Google. So they see value in Google. So that's going to help the Google stock, I think, attract more investors because with Warren Buffett and Berkshire Hathaway, it's a very high influence investor for good reason. He's been getting it done for 60, 70 years. Maybe he's 94. So yeah, let's call it 60, 70 years. The guy's been getting it done. So he has a lot of influence. And I think a lot of new investors are going to find the Google stock and probably buy it. We'll see how it helps the Google stock going forward. Going into next week on Monday, we're going to have trip.com, just a lot of smaller caps. Earnings isn't going to be really over until NVIDIA announces on Thursday. Up until then, we're going to have some smaller caps announced. Trip.com is going to announce on Tuesday. A lot of retail stocks are going to announce earnings to Home Depot, Pinduoduo, Medtronic, Futu. That's interesting for me because I own Futu. Klarna, that's a new IPO stock. James Hardie, they're in building materials for homes. All right. And then on Wednesday, we've got, I think I clicked on Tuesday accidentally. I could have sworn that NVIDIA was on Thursday, but it's listed under Wednesday. Let me take a quick look. November 19th. November 19th. So it's Wednesday after the market closes is going to be the big, giant earnings report. TJX, they seem to always do well. It's a discount retailer, Palo Alto. So it's going to be a big Wednesday. Lowe's, big retailer. Target, big retailer. Viking, Williams Sonoma, I believe that's a retailer. So a lot of retail stocks are going to be announcing. Wix, which is more of an e-commerce software company, will be announcing. So I look forward to that because I own Wix. Walmart on Thursday, Alibaba on Thursday. Alibaba is more of a e-tailer in China. Intuit, looking forward to Intuit earnings. NetEase, ROST, a discount retailer. So a lot of retail companies will announce, and I think retail, here's BJ's Wholesale Club. They are also going to announce. And all these retail companies, it'll set kind of the market understanding of the consumer. The US, 70% of the economy is the consumer. As the consumer spends on products and services, will dictate if the economy is growing or contracting. So their earnings will tell us about the economy. NVIDIA's earnings will tell us how much longer the data center rally is going to last, all related to AI. So we'll see how that goes. Looks like we've got a good number of people on the stream. Good to see you, Sam. Thanks for checking in. And some of you may be new to my stream because I don't typically stream on Saturdays, but decided to do it on this occasion. Just maybe hopefully to some new people see my channel and my stream. So I welcome you to check in on the stream, on the chat. And again, if you would like me to look at a stock, I'd be glad to. If you're a member, it's included in your membership. If not, a $5 super chat will get you in. All right, so that's a quick overview of the market. There was a stock request from a member. He wanted me to take a look at Ouster. And Ouster provides LiDAR sensors for the automotive, industrial robotics, and smart infrastructure industries in the Americas, the Asia Pacific, and Europe. Okay. Interesting. So this LiDAR, I think it's used for self-driving cars, and I'm sure robots have to use it. So if they're working in a warehouse, as an example, they could see where all the objects around them are. So that looks interesting. Let's take a look at their website. So there's a drone example. Here's an outside robot. There was a tractor on a field. That's what this company, their technologies are going into these types of products. So this is physical AI, and we're expecting that physical AI is going to show up quite a bit more. And it makes sense in a lot of industries. It's maybe that particular job is hazardous to the employee, or maybe they have a hard time finding employees to do those jobs. For example, I know that agriculture is tough, and if you can get tractors to do a lot of the work, um, then you can be assured that a tractor could work 24/7, and it's really hard to get employees for farms. Looks like Bo is back. How you doing, man? Good to see you. Well, I appreciate you paying a super chat on this, and please think about another stock as well if you'd like me to take a look at another one. And I'll take a look at Ouster, and knowing that you also were interested in it. So good to see you again, by the way. Thanks for coming back. All right, so Ouster, their stock year to date is up 80%, but you can see that the market isn't quite sure if it should go higher. Since June of 23, the stock hasn't gone higher. So interesting. They announced on November 4th, so we have some new data, some new information on their sales, their profits, their costs, and so forth. This is a small cap, 1.32 billion. Okay, they don't make money yet. And the revenue is 137 million, which is fairly good. You're buying this business for about 10 times revenue. If it's high growth, that's not a bad purchase price. So this is the full year. Yeah, thanks, Bo. Appreciate the support. All right, so let's take a look here. Um, so for the quarterly, the last quarter that they announced, their revenue is up 40%. That's very good. 39.5 being the total revenue that was generated. Looks good. And trying to see if maybe my sound's coming through my headset, which I hope it's not. I don't think so. Okay, so the revenue, I like that growth. That growth looks good. So why is the market selling it off? What did it not like? Let's take a look at the trailing 12 months. So revenue looks good. They've been growing well. Now, businesses that aren't making money quite yet, it's okay. It's acceptable if they're growing. These guys are growing. So I'm still interested. But I want to know, what kind of gross margins do they have? Because that will tell me eventually in the future, will these guys be able to make a lot of money, a lot of profit, a lot of free cash, or will they always be pressured by having a very small gross margin? So we're going to hit the gross margin line next. And right now they're a 42% gross margin company. It's not a very high gross margin because they physically produce a product, they deliver that product, it costs money to make that product, and so forth. All right. So good to know. They are losing money. They're burning cash as well. Okay. Let's take a look at their balance sheet. I want to make sure they don't have too much debt. And they do not. They have $244 million of cash and only call it $16 million of debt. So they have a cash surplus. And while I'm here, I'm also going to check what kind of burn rate they have. They're burning about $32 million of cash a year with over $200 million of cash. They got plenty of cash to grow the business, and hopefully eventually they can do two things: continue to grow, continue to expand those margins. This stock is covered by 6 analysts, and collectively, on average, they think it's discounted by 42%. Now, there is an analyst with a low price target of 14, but the high is 50. Looking at their forecast, they're supposed to keep growing. And that looks pretty impressive to me. Now, this one isn't showing me enough value, or I should say, the fundamentals around cash and profit aren't there. So it's hard to value this stock. I would say that the price to sales ratio is affordable. It's not overpriced. The growth rate is good. The forecast on growth rate is good. They're carrying well over 200 million in cash in excess of debt. So really, you're paying about $1.1 billion for a business that has a fairly strong future. These products, they're going to be sold. They're going to be sold into use cases for physical AI, whether it be these. I'm already seeing them in cities. You have these robots that are either mainly on the sidewalk or they're in parking lots, and they're observing. Maybe they're observing so that they can prevent theft, break-ins into cars, or better yet, maybe there's a bad actor hurting people or something, or they can pretty much kind of be additional eyes and sensors for law enforcement and security. I'm seeing those quite a bit now, and it's a good idea. I mean, you can have more security using these robots, and Ouster is probably going to put a lot of their components into that particular product set. So this one here would be an interesting stock. It would be potentially a buy, but I'd have to be really comfortable with the business use case. I'd have to study the company. I wouldn't be doing it on fundamentals. I'd be doing just on principle of the idea, more qualitatively. But if an investor invested in Ouster, I just couldn't argue. I'd be pretty interested in seeing how this is going to follow through. And if the fundamentals continue to get better, and they start producing some profit, or really are forecasting profit, and maybe get into a positive cash flow position, then I'd really be ready to go. So this one might be a little early for me, but if somebody really understands this area, this industry, this is a good idea. So to both investors that are interested in this, both Bo and I think it was Mike that was interested in OUST, this is a good idea. It's just, what kind of investor are you? I like to look at businesses where I could forecast their profit and free cash flow. I can't do that with Ouster just yet, but I still believe it's a good stock. So that's a quick review of OUST. All right, so looks like we've got more people on. Thanks everybody for joining. So one thing I wanted to do, and let me just remind you, if you guys want me to look at stocks, I'd be happy to. I'm going to get into a list of stocks, but if you would like me to look at a stock and you're a paid member, just put it in the chat. If not, $5 super chat and I'll cover it. And between now and as people request reviews, I'm going to take a look at some retail stocks, because retail is coming up. We see the earnings coming for Target, Walmart, Home Depot, and I wanted to kind of just start doing some homework. I don't own any retail stocks, but it might be interesting to take a look at some of these and see, where are they currently? Have they been rallying? Are they, stuck behind a rock in a hard place. So let's take a look. So this is Target, and these guys have not been doing well, down 42%. 5 year looks bad. They pay a big dividend, 5%. Oh, that catches my attention. That looks pretty interesting. Now, Target, you know, I happen to think Target's a good store. Now, they're not perfect, right? I think their catalog, their assortment is good. I know my family, my wife shops there quite a bit because I think they have certain things that we tend to buy regularly. And it seems like whenever we need a gift, we've got little kids in our family, and whenever we need a toy or something or electronic and we don't want to go somewhere else, we just end up at Target. They also have grocery at Target, which is increasing foot traffic. That's a good idea. So the stock is down, PE is really low, and analysts think it's discounted. Looking at their revenue, their year ends February 1st. And this is referred to as the retail calendar because they like to end a month after the calendar year ends. That way, during the holiday spike in sales, you give the consumer about a month to return items maybe that they received for Christmas and don't would like to either get a refund if they have a receipt or a gift card and so forth. So that's why it's the retail calendar. Looking at the trailing 12 months, they have hit a wall in growth. That's not a secret. That's why the stock is down. They're trying to figure out how can we grow? How can we grow this retail giant? For a while, like 10 years ago, this was a pretty successful company that was growing quite a bit. Seemed like consumers were really happy with Target. They are a low margin business because it's retail, and now they're in groceries, so it's not going to be the highest margin industry we're going to find. We are seeing gross margins of 27.8, and let's look at the gross margin history annually and see if gross margins have been changing over time. You see that in 2018, this is before COVID, the margins were around 29, almost 30 during COVID. And then we've had in 2023, they started to see their margins go down, and they're beginning to recover that margin rate. That's really good. That's really good. How you doing, Shadow Guy? It is very good to see you. Thanks for joining. So that looks interesting. I'm glad to see that that's getting better. All right, so looking at what analysts are saying about Target, 26 of them cover Target. They're saying on average that it discounted about 20%. Some analysts believe the stock could go up to $150 a share, and the worst price target is at 80. So the downside risk isn't all that bad. I think it's sold off so much. How much lower can it go? It had pretty decent free cash flow of $3 billion, and it's a $40 billion market cap stock. So I'm going to do a valuation on Target, and we'll arrive at an intrinsic value based on free cash flow, and we'll arrive at an intrinsic value based on earnings per share as well. But for now, let's kind of see what analysts are saying about this stock. Looks like Benton joined. Good to see you, Benton. 1K. And you got a comment on? They've had a rough time, but let's see what the future is supposed to bring. Now, we are in the year that's going to end February 1st, 2026. And it's supposed to be revenue is going to be flat and profit's going to contract. Based on the forecast, they've made some changes, and analysts expect that they are going to begin to grow, although it's going to be slow growth. They are a big company, over $100 billion of revenue. More importantly, the profit's going to expand nicely and bring down that PE ratio down below 10. Looks pretty attractive. Attractive for maybe an older investor that really likes dividends. You're getting a 5% dividend here. That's pretty attractive. And you have some upside potential here. Let's say Target delivers a 10, 20% appreciation on the stock price, and then you get that dividend. That's a winner all day long. Can it go down much more? I don't think so. I think it's already gone down quite a bit. So this is a more conservative, stock that I would be looking at. If I was talking to, let's say one of my sons, a young investor, one of my sons is 25. Let's see, I was talking to him. I would want him to swing for the fences, growth, try to find great companies that are going to just, really, really go up in price. It wouldn't be Target. But if I was talking to, let's say, one of my friends that's in his 50s, I'm in my 50s, be like, Target isn't a bad idea right now. Good dividend, priced really well. They do have a little bit of debt, net 16 billion of debt. And if we go debt to EBITDA, which is a ratio that's important, 2.18. So they do have some debt, but it's not a problem. If you got above 3 is when a company starts becoming risky based on the balance sheet. So the balance sheet is in decent shape for Target. So I like what I'm seeing with Target. Let's jump into evaluation of Target. I'm going to open up another screen you guys can't see in order for me to update my valuation model that I have for Target. And I saw a quick note on Walmart, and we'll compare Walmart with Target. We'll get there and we'll see. It's not a matter of, and I think once we look at a few of these retail stocks, it's about when we buy, how we buy a stock that makes a big difference. Sometimes it's really wise to buy the most successful company in a particular industry, like Walmart or Costco. Got it. But if you're paying a really expensive price for those stocks, it may not be a good idea. If you're getting a really good deal on maybe the second most successful company in general merchandising, maybe that's a better option, because I know Walmart doesn't pay much of a dividend and the stock is up quite a bit. So Walmart and Target go after the similar consumer, but I would say that the assortment at Target is probably priced a little higher than the assortment at Walmart. I don't shop a whole lot at Walmart, but I do shop at Target. Not a big shopper, but every once in a while I end up at a Target. All right, so I'm going to do a valuation. I copied the model that I created for Walmart. You see that I've got a pretty big premium on Walmart, but I'm going to update that in a few minutes. Let's just work on Target for the time being. Then we'll see, is Target being discounted or is it priced at a discount? All right, so interest rates are moving down. I was thinking of maybe moving this to 7.5 as my discount rate, but I'm going to keep it at 8. What kind of free cash flow does Target produce? And I'm going to look at the trailing 12 months free cash flow. That's where that information is going to come from. And the free cash flow trailing 12 months is $2,944 million. So they're not growing a whole lot, but they're supposed to grow in the future. So I'm going to leave it at 4%, just a tiny bit above inflation. Long-term growth of 4%. The cash on the balance sheet was somewhere around $4 billion. And it was $4,340 million. The debt was $20,400 million. So the stock is priced 27% below its value based on free cash flows. That's attractive on a business that's pretty steady, pretty reliable. I'm pretty comfortable with. And earnings per share. Let me take a look at what's being forecasted for the year that's coming. And the earnings per share is supposed to be $8.06. Now, I can't give them a 25. I'd give them an 18 because it's a reputable business that I've known of. So overall, Target's discounted, and it makes sense. Over time, the market's really sold this thing off. They're expecting to start to grow. It's a discounted stock. I don't think this stock's going to set any appreciation records. It's not going to be the next NVIDIA. But for a more conservative investor, older investor, you're looking at a 5% dividend on a stock that's discounted. So it's got my attention. So Target for me is a buyable stock. Now let's take a look at a few retail stocks and then we'll form a conclusion. Let's go over to Walmart, which is the big monster in the space, right? And Walmart, of course, they're gigantic. I think they're like 600 billion in revenue, 680 billion. Geez, humongous. And they are an $817 billion market cap company. Target 40 billion, Walmart 817. So Walmart is 20 times more expensive than Target. Interesting. Target's 100 billion. These guys are close to 700 billion. So Walmart's 7 times bigger from a revenue line standpoint, but it's 20 times more expensive. Okay. The stock's been performing. It's been going up while Target's been going down. It's been going up over the last 5 years while Target's been going down. That's the difference. One stock's been going down. One stock's been going up. Now, it's not about looking in the rearview mirror and saying, well, Walmart went up for the last 5 years, so I guess it's going to go up for the next 5 years. Nope. That's not my form of investing. My form of investing is looking at the business qualitatively, trying to take information in and making a good forecast and saying, this is how Walmart's probably going to operate, and this is how their stock's probably going to trade going forward. So let's go through that. So we know that these guys are big. They pay a tiny dividend of 0.92. Again, Target pays 5% dividend, and the P ratio is way up there, 38.68. Whew. Now, these guys are growing at 5% on a big number like that. That's pretty darn impressive. Looking at the quarterly, the last quarter, they grew at 4.76%. So Walmart's getting it done. They're growing consistently, so operating quite well. Some news on Walmart. The CEO is retiring. He's going to hand the company over to his successor, and I'm sure he's going to do a fine job. Now, Walmart produces almost $14 billion of free cash flow. Our friends at Target produce, I think it was close to $4 billion. So again, Walmart's 20 times more expensive. If you look at market cap, they produce 14. Target produces about, let's call it 1/4. They actually produce more than that. So their cash flow for Walmart is less than 4 times more, but their market cap's 20 times more. So I'm seeing that Walmart's expensive compared to one of its peers. All right, so gross margins 24.9. Our friends at Target have better gross margins. So looking at the balance sheet, how much debt does Walmart have? $66.5 billion of debt and $9.4 billion of cash. Their debt to EBITDA is 1.43. So their balance sheet's fine. It's not in any trouble. 30 analysts cover it. They think there's a 10% discount available on Walmart. They think the lowest price target, 91, highest 129. So this range is pretty tight. So the conviction's there across 30 analysts. So very consistent company. This one here, let's go ahead and update my valuation of it. I gave you kind of a preview. And let me just double check to make sure that I updated it on the 7th. And let me see if the numbers have changed since then. So, discount rate, I'm going to go with 7.5 because these guys are operating quite well. Low risk stock. It's Walmart. It's not going to go anywhere. It's not going to go bankrupt. And their shares outstanding. Does that look right? It does. Looks good. Okay, now let's update this free cash flow. And the free cash flow for the trailing 12 months is, yeah, that's correct. So it's been updated. So it looks like I've got these numbers updated. So let me just double check on earnings per share. So the earnings per share for the year that's coming, $2.96 on the button. Give them a generous PE ratio of 25, not anything higher. They're growing at like 4 to 5%. I'm not going above 25 PE. I don't care if everybody is familiar with Walmart. That's what I'm willing to pay. So the company is priced 47% above its intrinsic value. The value of its cash flows are $40.96 per share, but the price of the stock is being sold at 102. And on earnings per share, it's better, but it's still priced at a premium. So Walmart would be a sell. Let's think about that for a minute. It's gone up more than 100% stock price. It's been growing slowly, low margins. The free cash flow is okay, but I showed you how Target actually generates more cash flow as a percentage of its sales, and much better free cash flow as a percentage of market cap. So Walmart most definitely would be a sell for me. It's just priced too high. It's a dependable stock. Now, some of these stocks tend to be attractive to people because the retail investor, everybody knows Walmart. There's comfort level, conviction, confidence in a business like that. So it would be a stock probably for an older investor that just wants steady appreciation and a dividend. But this older investor wouldn't touch Walmart. There's just not enough value there. I'll let others invest in it, and I'm going to try to find a retail stock that is going to give me a better chance of outperforming for the next 5 years. My intent is to have a stock double over the next 5 years. And again, I can't invest by looking at the rearview mirror and just being happy with the performance of a company based on what they did for the last 5 years. That's not good enough. So we just cranked through Target. We cranked through Walmart. Let's talk a little Costco. In Costco, I updated on the 25th of September. Let's see what they announced more recently, what the stock's been doing. Now, Costco is a stock that a lot of investors own. It's been a good stock for many investors. 1 year hasn't been perfect. It's down a little bit. 5 year, it's up 143. So most definitely coming out of COVID, a real good stock. And I think people appreciated Costco because so many people were going during COVID to buy all their volume essential purchases as well as other things they sell. And the stock really rose nicely. So it was kind of a real good move for the last from 2020 up to toward the end of 2024. But the last year hasn't been good and it pays a tiny dividend. So what's going on with Costco? Is the underperformance going to continue? What's happening? And I'm having a cup of coffee, and I'll mention that I got that coffee pod at Costco. They give you a giant box of pods for like the best deal in town. So I got to buy them there. I buy certain essentials at Costco because it's such a good deal. They also have a good delivery option. So I like that as well. All right. So Costco, $409 billion market cap company. It is a trusted name in retail, $275 billion in revenue. It's not quite 3 times bigger than Walmart, but it's bigger than Walmart. Target. Target was a little over 100 billion. And the PE is really high. Even though the stock didn't perform for a year, the PE is still at 50. Oof, it's expensive. Analysts think, well, there might be a discount there. So the growth is good in the year that ended August 31st. That's pretty good growth, 8%. And our friends at Costco here, a good way that they make their profit is the whole membership. The membership program is almost 100% profit. That's where they really depend on profitability. They generated good cash of 7.8 billion. And that's pretty darn good. Their gross margins are lower than both Walmart and Target because part of their proposition to the consumer is come to Costco, you get a better deal. And I believe that. I shop there for certain things, and I'm fairly certain that I'm getting the best deal in town. And that's how they do it, is they go really low margins. They make money on that membership, and they have a lot of loyalty from its consumers. So can't argue with that. They have a model that works. All right. So what kind of debt does Costco have? They've got less debt than cash. Nicely done. So terrific balance sheet. And it looks like analysts, some of them are quite positive on Costco, saying, hey, this stock can go up to 1,225. The worst price target's just underneath its current stock price. It's discounted by about 15%. Looking at the forecast, it is impressive that they continue to grow on a very big number. So nicely done there, Costco. And their earnings per share is looking pretty good. It's going to grow better than revenue, so that looks good. But their P ratio is still expensive. I mean, I could buy Meta at a low 20s, and they're growing by 26% with much better margins. Why would I buy Costco? And Meta's huge. Meta's like 200 billion. So it's not like I'm buying a little company. I could buy Google at 29 PE or so. And that's what Warren Buffett's buying nowadays. So this PE ratio just looks expensive. All right. So let me update Costco's model, see what it's looking like, see if it's a stock that is setting up to be a good investment for a more conservative, safe investor. All right, so trailing 12 months. Let's take a look at that number. What was our trailing 12 months free cash flow? $7,840 million. I'm giving them a generous growth rate, and maybe that's too generous. I'm going to go to 10. It's still above their sales growth. Okay. And they do have more cash than debt. Nicely done. And their debt number, that looks correct. Earnings per share for the next full year over at Costco is $20.49, so just a tiny bit higher. I'm willing to go to a 25 PE. So Costco's priced 34% too high. And it shouldn't come as a surprise that they're an expensive stock. The market has basically said, hey, it doesn't buy Costco stock in 2025. It's been a seller of Costco stock. So the selling may continue because I think it's an expensive stock. So Costco is not a buy. It's more of a sell, maybe even a hold, but not a buy for me. I want a discount. I want a good price stock. So that's what I'm looking for. Or I'll keep my money in cash and bonds. Those are delivering high 5% appreciation and rate of return, overall performance. That's with almost no risk. So why risk my money on Costco when it's not going to pay me a dividend? And for all I know, I'm sitting on a 10% loss after 12 months. So that is Costco. So we've gone over 3 fairly big retail stocks. A lot of chat going on the chat. Thanks everybody for joining. Monty's Killer Rabbit. You're all over it. Good to see you. Volko Finho. Good to see you. And Michael Anthony. Good to see you. Mark Stan and Bo. Thanks everybody. Thanks for the activity there. I'm not seeing any stock requests out there. Looks like we handed OUST, and I'll keep going on these retail stocks. Again, if you'd like a stock to be analyzed, $5 super chat, and we're off to the races. We can analyze the stock of your choice and go through everything that you're seeing there that I did if the numbers are available. Ouster didn't have any numbers that were available. A company that's going to announce next week is Home Depot. This is a very well-known company, $360 billion of market cap. Now, we're not necessarily in a housing boom market. Year to date, it's down close to 7%. 1 year down 11.66%. The 5-year up 30.74%. Pays a dividend at 2.54%. And the trajectory has been quite positive since, I guess, 2022. We've seen an upward stock movement. So what's going on with the Home Depot? Is this a stock worth having? Let's take a look. So the revenue is $165 billion. So paying about 2.5 times revenue for the company. P ratio is at 24.6. Okay. Looking at growth for the business, the last full year they grew by 4.5%. Good growth in the last 12 months, 8.5%. That looks pretty darn good. Let's take a look at their margins. Gross margins look okay. This is retail, so it's not like we're Nvidia making 80% gross margins on GPUs. This is retail. All right, so the Home Depot forecast, 18 analysts cover it. One analyst is at 497 as a price target. Low price target's 370. So everybody's above their current stock price. So they believe it's discounted by 21%. Looks good. Okay. And when we look at the forecast looks good. We've got green on the screen. We're operating in this year here that they're supposed to grow by 6%. They most definitely have been doing that. So it looks good. Earnings per share is expanding. Okay. And the P ratio is going to drop unless the stock price rises. So those are good things to see. Those are good things to see. If I'm looking for a stock that's going to go up in stock price, Home Depot is showing some potential, it's showing some decent potential. All right. So let's get cracking on a valuation for Home Depot. I think I've got Home Depot somewhere in this big repository of stocks. Maybe I don't. Looks like I don't. Gonna have to add it. Yeah, let me add it. All right, so we'll add it right underneath target. All right, Home Depot. We'll also look at Lowe's. So I'm going to go with 7.5 on Home Depot. They're just I think a solid business. Take a look at their balance sheet and see if I'm going to change that opinion or not. But let's go with 7.5 at this point. All right, what kind of cash flow do we have coming out of Home Depot? Let's take a look. So they have, let's see here. Free cash flow, 14 billion, 230 million. That is good looking cash flow number. I could personally say that, man, I spend a lot of money at Home Depot. And over the years, it's in like over 100 grand, I'm sure. All right, so we've got free cash flow there. What kind of debt are we dealing with? Now, they do have a pretty good amount of debt. They have debt to EBITDA of 2.21. So their debt level is okay. It's just a big number. So let's deal with it. So they have $2,800,000,000 of cash, 61,920,000,000 of debt. So that debt brings down my equity value. Home Depot is fairly priced. So not providing a very good discount available. Looking at their earnings per share that I'm expecting over the next full year, $16.76. Well-known business, growing. I'll give them a 25. So this is a fairly priced business. This can go to 7. And I'm not looking for a fair price. I'm looking for a discount. I'm looking for a stock that's going to double in value over the next 5 years. So Home Depot is not looking like it's an ideal stock. It'd be a pretty good hold stock. I don't hold Home Depot, but for me, that's not good enough. I'm looking for a winner. I'm looking for something that's going to double in value. For example, I own Kroger. And I could easily add Kroger to the retail stock list because they retail groceries. I've doubled my money on Kroger in less than 5 years, and they paid me a dividend on the way there. So it's not about, hey, I'm going to buy a name that I know. I want to buy a name that's going to deliver the return that I'm looking for, or I'll keep my money in cash. My man, Bo, what are my thoughts on Lyft and Uber? Man, you are bringing up a topic that I have a lot to say on. Let's get into it. Let's get into a full-blown positive argument around Lyft and Uber. Lyft, I'm going to give you a spoiler, is discounted I'm going to show you how well discounted. But let me take it from the top. The Uber and Lyft battle has existed for about 20 years. Lyft and Uber that was Coke versus Pepsi. But Uber pretty much put a very big distance between themselves and Lyft in the form of overall revenue, market share, profitability, momentum, you name it. Now, Lyft is not a bad idea for an investor that is more value oriented and believes, if Lyft can catch a few breaks, that could really be a nice doubling of my investment, heck, maybe even 4-bag. So let's take a look. Let's start with Lyft, then we'll come back to our friends at Uber. This is a small cap, 9.24 billion. Revenues are 627, which is a very affordable, very discounted price to sales. And they make money, and their forward P is 17.5. And I could tell you these guys are growing because I look at Lyft and Uber quite often. Analysts, I don't agree with them. They think it's priced 3.37% too high. Before I move there, let's take a look at the 1 year. It's up 30%. So the fundamentals of this business are catching the eye of investors. Now, the 5 year isn't going to look as pretty because Lyft really started falling behind. And the market was like, okay, you guys are not going to be competitive to Uber. All right, well, let's get over it. Lyft is not going to be competitive to Uber overall, but it's a good business. I'll show you why. And the market has been buying it up. And I kind of look at it and go, man, maybe I should have bought Lyft. It looks like a pretty promising story. Look at that, 79.38. And I think there's a lot of meat left on this bone. Let me show you. Green on the screen. All these quarters, we've got growth. Well, that looks pretty darn good. Trailing 12 months growing by 15%. That looks very good. They have profitability. They have to pay the drivers and so forth. So it's not like a super high margin business. They're going to have a margin of roughly 33%. It's not bad. Looking at their forecast, Lyft is looking like it's going to grow. Profit. And the profits are really expanding. Okay, look at these. It's going to double next year. It's going to go up 43% after that. It's going to go up 98%. And those numbers are real. This business is quite a bit smaller than Uber. And I happen to think that Lyft might be a really good acquisition target for the companies that want to do robotaxi to get that customer base and start offering your robotaxi service through the Lyft network, or maybe Lyft will partner with people. All right, so from here, I'd like to look at their debt to EBITDA. I believe they have more cash than debt. They do. They've got a surplus of $673 million. Terrific. So this business here is, man, this was a nice pickup. I decided to consolidate my position in Lyft, Uber. So haven't been a player, but boy, those who played Lyft have been rewarded. And I think there's more left. Let's take a look at my valuation of Lyft. And then we're going to take a look at Uber, just so that you can see two stocks that are similar, but are in different places. Okay. Lyft, in my opinion, and I'm going to update these numbers just to make sure we're dealing with the latest and greatest, because it looks like I updated it in May. And when we did Lyft on streams back then, I was positive on the stock. And I continue to say, Lyft might be acquired, and whoever owns the stock is going to wake up one Monday morning or Tuesday morning and Lyft's being acquired by so-and-so. And, You're going to be paid 40, 50, 60% premium on your shares, and you're going to have a smile on your face for about a week. I think that's going to happen. All right. There's a good chance of it happening, right? No one can tell, but I'm feeling like that could be the case because this robo-taxi market's going to get really competitive. All right, enough talking. Let's put in some data here. So I want to look at free cash flow to get started. So our friends at Lyft are driving over $1 billion of free cash flow. Rock and roll. Over $1 billion from a $9 billion market cap company that has more cash than debt on the balance sheet. That's a very discounted stock. If it's growing by 15%, it's a really, the numbers look good. Okay. I know that they're losing the battle against, or the war against Uber, because Uber's taking more market share. Those numbers look great to me, man. Money's money. It spends the same, whether you got the number one player in the market or the second place company, because it's how we buy a stock that matters. If we buy a stock when it's really discounted and it goes up, and most definitely Lyft stockholders have experienced that this year. They're up 80%. Who cares if Lyft isn't catching Uber? You made 80% on your capital. Congratulations. That'll pay for a lot of Lyft rides. All right, let's take a look at cash. They got $1,990,000,000 of cash, $1,320,000,000 of debt. Woohoo! Nicely discounted. And that's with a discount rate of 10%, folks. And really, I should move it to 8. Now, the reason I went to 10 is they're just behind Uber, right? But I'm going to move it to 8 because that's where they have a terrific balance sheet. You know, some people are anti the biggest player in town. Like, you know, I know people that don't shop at big box retailers because they just hate the big corporate kind of situation. So let's go with those numbers. All right, earnings per share. I showed you how these guys are going to expand their profit really, really well. And next year, they're going to do 55 cents per share. And they're going to grow at 13%. So I put more weight in free cash flow. This means more to me. It means more to these famous investors, Warren Buffett, Michael Burry, you know, all these famous investors. If you hear their vernacular, they talk about free cash flow. That's where you value a company. So Lyft is nicely discounted. Okay. It's a very nice option. Now let's talk about Uber, because Uber and Lyft, again, the battle was fierce 15 years ago, but the battle was kind of lost to our friends at Uber. Uber is also discounted. So I've decided to concentrate my investing in Uber. I own a lot of Uber shares, and I'm good with that. I'm good with that investment. Now, am I doing as well as anybody owning the Lyft stock? No, not year to date. I'm falling behind them. But I think overall, I really like this trajectory. I think I'm sitting on what will be the winner of mobility. They also do food delivery. They've got a strategy for robo-taxi that is going to involve partnerships. So I think Uber is going to get me to the promised land within this particular market, but I really like Lyft. So I would not argue with an investor wanting to buy Lyft. You're buying a good opportunity. You're buying a good opportunity in Uber. So that's for you, Bo. What do you think? Which one is your choice? Which one would win Bo's vote between Uber and Lyft? So analysts are worried about Tesla and Waymo, but you have to be sensible. You look at Waymo, Waymo's been around for 20 years, and it's taken 20 years for them to get to these major cities, and they're growing steadily, but I think they have like a couple percentage points of market share. While Lyft and Uber just dominate the market and more Uber than Lyft. So I think that, it's going to take a long time for those companies to really be a factor. And Tesla's most definitely a wild card, right? They're not even operating a robotaxi service at this point. They tested in Austin. They had, I think, 20 riders ride in the cars. But I think Waymo's doing well. I own Google. It's my biggest position in my portfolio. I would like to see Waymo dominate, but I'm being sensible. We're a long ways from robotaxi being even 10% market share of the taxi / mobility market. We're a decade from that moment. 20 years from now, would it be mostly robotaxi? Probably, but I'm not investing with a horizon being 20 years out. So that would be my opinion on that. Yeah, if Lyft gets bought out, it's good for them because they need to be part of something bigger. Uber's gotten gigantic at $190 billion market cap. So if Lyft, think about, let's say Lyft got acquired by Airbnb. Airbnb is like 60 billion or so. Now they're part of a bigger ship, right? Now it's like, hey, Uber, we're getting bigger and stronger and we got more resources. And maybe like an Airbnb could offer free, while you stay at a vacation rental, you get free Lyft services and stuff. That kind of thing, I think Lyft needs to start merging and partnering a lot more because it needs more, I think, a bigger mass of revenue, market penetration, access to markets in order to be a player. So that's where I'm at there. Benton. So you own them both. Can't argue with that. Cannot argue with that. I'm glad you're making money. You make money on both. Nothing wrong with that. Michael Anthony, good to see you, man. Nicholas, good to see you. If you want me to cover Reddit, $5 super chat or become a member, I'd be happy to cover Reddit. I've got a lot to say on Reddit. Man, that was a spirited conversation on Lyft and Uber. Thank you for asking. And hopefully you found my comments interesting. Now you're a member of the channel. So there's a lot of videos that I've put on Uber and a couple on Lyft. So if you search my channel, even if they're member only videos, you should be able to see them if you wanted to see more on those. So thanks for asking. Interesting topic. Let's move over to Lowe's. Wait, let me catch up on something here. Michael Anthony, the debt on Lyft was like 1 point something. It was less than cash. Burry is closing. Maybe, or he might. I don't know. It'd be a wild guess. Michael Burry's had a very interesting. Hold on a second. One more. So if I was starting a position today between Lyft and Uber, I would pick Uber because I want to make a lot of money over the next 5 years. I think Uber is going to be the next $1 trillion market, could be one of the next $1 trillion market cap companies. And it's going to get there because it's already big, 44 billion, growing at 18%, faster growth than our friends at Lyft, even though Lyft is smaller. 20% growth on a big number. At that rate, in roughly 3.5 years, they're going to be 88 billion. And then they're going to double again. Well, I think they're going to double their stock price in 2 to 3 years. And then they're just going to, that momentum is going to keep building. So I think Uber from here could go up a lot over the next 5 years. So Uber would be my choice. And if I had a choice between quality that comes with great fundamentals and the market leader, I'll always take that one ahead of the one that's being left behind, right? Lyft culturally probably doesn't have like the fire and the passion and the killer instincts that Uber does. Uber is getting it done. So that would be my answer to that. And then I think I talked about Burry a little bit. So, Michael Burry's been super interesting. I don't know if you know this, but he's a trained medical doctor. It's like, so he obviously is a very successful investor, big short. I think the guy can go in 100 different directions. We'll see what he does next. He could have been losing money. I tracked Michael Burry. He was making a lot of money early in the year. And then I tracked that he sold his winners and they kept going up. So maybe that was a mistake, but that's just specific to 2025. Last couple of years, he did lose some money, but he did make a lot of money in 2010, 2011 when he shorted the subprime market. All right. So moving on. Good stuff, everybody. Lowe's. Let's talk about Lowe's. So Lowe's is similar to Home Depot, and they're a $127 billion market cap company with revenues of $83 billion. P ratios look pretty reasonable, and price targets 21% higher. When we look at, let me just go straight to the forecast on Lowe's. We are in this year, they're growing a little bit, 2.74. They had a couple rough years in 24, 25. They're growing nicely next full year. They're going to continue to grow according to analysts, and their PE ratio is going to come down a bit. So that looks good. The profitability is going to expand. So things look promising for Lowe's. Over the last year, it's been selling off. That's not a bad chart. I mean, it's not a super winner. You add that dividend rate, maybe you're up 55% versus, losing money. But I like the trajectory, right? It's kind of been going up. So that looks pretty interesting. All right. Let's do a valuation on Lowe's. We just finished Home Depot. So we got Home Depot on the board. Let's compare it to Lowe's, see which one's a better deal, see which one potentially would be a better investment. I like looking at a variety of stocks within a sector and an industry because you can compare peers. Like we just compared Lyft and Uber. Those are peers. And you have that choice. Hey, do I want the smaller player that could go up, but it went down for a reason, right? It went down for a reason. And Uber has expanded much faster for a reason. So you get to compare those peers to one another. So let's compare Lowe's. All right, so I might change this to an 8, but let me get down the road a little bit, make a decision later on what the discount rate ought to be. So what kind of cash is Lowe's producing? Cash flow is $1 billion. $1 billion. Nope, still looking at the wrong one. 1 second. Cash flow, $7,690,000,000. So I'm going to stick to that growth rate. We're fine with that. Okay. Now let's take a look at cash and debt. We have $5,260,000,000 of cash and debt. $39 billion of debt. So there's a discount available on Lowe's based on the cash flow they've been producing. So that trajectory in the stock also, whenever I see charts like that, it gives me a little more confidence that, hey, they're building something that keeps adding value to the enterprise. So looking at their earnings per share that I expect for the next full year, $13.49. P ratio, they're growing decently and expanding their profits by 8 to 9%. So 20 is a little generous. So Lowe's is discounted by 27%, and investors will be paid a 2.1% dividend. For a low risk investor, this could be a nice buy. It's shown a nice trajectory on its stock where the stock price, you see, if I drew a line, it'd be upward and have a pretty consistent upward trajectory. So Lowe's is looking pretty decent within the retail space. I think compared to Home Depot, it gives us a better opportunity. Home Depot is fairly priced just with a small discount, where our friends at Lowe's provide a better discount. If we have a growth in housing, and the current president's trying to lower interest rates, and lower interest rates is going to help real estate. So if you have more real estate transactions, you have more households being created, Lowe's and Home Depot will benefit from that. All right, let's keep moving. We're getting through a lot of stocks, good stuff. Got a lot of comments out there. Thanks everybody for weighing in. A lot of interesting stuff out there. Amazon. I love Amazon. Good stuff. All right, let's keep rolling. Let's turn our attention to TJX. TJX is a discount retailer. It is up 20% over the 1 year, up 145% over the 5 year. Wow. Incredible. These guys know how to buy their merchandise and then provide good value to its consumer. It does have a high PE ratio. Analysts think it's slightly discounted. So the stocks really work, but has this company been growing its revenues? And they have, but man, this growth is pretty small. Last quarter, 7%. Trailing 12 months is growing by 4%. So this is a well-recognized name, but man, the growth is unimpressive. Free cash flow has been kind of idle, kind of flat for a little while. Gross margins at 30%. So a little bit better than our friends over at Target. So they're growing a little bit, providing a pretty good stock appreciation run for its investors. 17 analysts cover it. The best price target, $172 price target. And we got 131 is the lowest. The growth of the company, they're going to grow 5.7, 6%. It's a pretty big outfit. and the profit of the company is also going to expand nicely. So their PE ratio could come down to 23.6. And I'm uncomfortable with a company like this being a 30 PE ratio because they don't have a lot of margin. And it's just not a really desirable business for me. I could, again, buy some pretty desirable businesses for a better PE ratio. But let's see where these guys price when we look at their free cash flow value and other factors. All right, so TJX, and I think it's TJ Maxx. Okay, so looking at their fundamentals to upload in here. So they free cash flow $4.04 billion. And they are growing nicely, so I'm going to give them a 6 on growth. Cash on hand is $4.64 billion, and debt is $13.12 billion. So is that the right market cap? Yeah. Geez, this business is expensive. It's priced 31% too high. And they gave them a favorable growth rate, so a really low discount rate too. Just too expensive. And looking at the history of the stock, last 5 years, this stock's been going up, but doesn't mean it's going to keep going up. You saw what happened at Costco. That's an expensive stock. It hit a wall, and now investors are like, whoa, what happened? I'm not making any money on Costco. So earnings per share is going to be $5.12 going forward. They are growing nicely, so I'll give them up 25. So TJ Maxx is 23% too expensive. It's a sell in my book. All right. So TJ Maxx, not cutting it. It's had a really good 5-year run, but it's not about where a stock's been. It's where it's going. We make money in the future. We don't make money in the past, where I would have bought, where I could pick out all these, stocks I'd love to buy if I had a time machine, but I don't. So I'll have to make my best estimations and pick the right stocks. All right. Moving on. So the next one I'm going to cover is going to be ROST stores. It looks like somebody wants to look at Bull. Be glad to do that with a $5 super chat, or if you become a member, I'd gladly do that. So those would be your options. ROST stores, together with its subs, operates off-price retail. This is a lot like TJ Maxx. Over the 1 year, up 14%, up 48.5%. Not bad. It pays a 1% dividend. $52 billion market cap. The business has been growing. Last quarter, you've got some good quarters in here. Small growth, but growth nonetheless. So looks okay. So Ross, 14 analysts cover it. One analyst is at 180 and then 130. So it's a pretty tight range. They think there's about a 1% discount. It's expected that Ross is going to keep growing. That looks pretty decent, and profits are going to expand at like almost twice the rate of their revenue growth. So that looks good. If the whole, tariff thing goes away as well, that's going to help Ross and TJ Maxx. All these retailers will benefit from if tariffs go away. between China and the US primarily, because that's where most of their inventory is coming from. So, all right. So let's take a look at a value of ROST. We just did TJ Maxx, comparable stock. So let's compare it to ROST. Okay, let's see, what kind of fundamentals do we have here? So free cash flow, $1,680,000,000. I'm going to move that to 5%. All right. Cash on the balance sheet, $3,850,000,000. So it's priced a little too high. It's been appreciating and it's priced right. That's a premium a price, so not all that attractive. Now let's take a look at their earnings per share forecast for the next full year. $6.99. Yeah, Ross is not all that exciting. I would not buy. That's just not showing me enough. So we're going to get earnings from these stocks next week. Just doing some homework on them, kind of get ready for them. And we'll see what they announce. They'll tell us a lot about the economy and where the economy's at. And we'll see where they go. All right. So all right, let me check in on the chat, see what's happening. Thanks everybody for joining the stream on the weekends. It's been kind of a wild market. We've had some sell days. We've had some days where stocks have really moved. And I think this coming week, we're going to stick to that volatility. I think the volatility is going to be with us for probably through the end of the year. I think there is some fear out there. If there's, it might be a case where some stocks have been announcing and the earnings look good and the stock sells off. And that could be the case for Nvidia. They may come out and say, "Hey, here's how great our numbers look," and investors sell off because they're like, "Okay, this is as good as it's going to get," and they sell off. I don't know if that's going to be exactly what happens, but I think there's a chance that that could happen. So, all right. So we covered all those stocks. And for all advanced members, advanced or super investors, you're going to get a copy, or I should say, you get access to a shared folder. You just always have to get me your email address, and I get you access to the shared folder, and you get a copy of this. I update it once a month, sometimes twice a month. Then you'll be able to see all these particular companies. So just remember that if you're a advanced or super investor, you will be able to look at these particular valuations and research that I've completed. So keep that in mind. I know several members are on the stream. Okay, so one thing I want to do is I want to update my watch list. So let's go ahead and do that. And retail belongs to consumer discretionary. And here we are. Bear with me. I'm just going to do a little data entry here. If you guys want to think about a stock you want me to look at, please do. $5 super chat. We can analyze it, or if you're a member, you can just put it in the chat and we can look at it. So bear with me. I'll get through this and then we can talk about other stuff. In the meantime, again, if you want me to look at a stock, put it in the chat. All right. Got my data entry in, adding those valuations, and we're good to go. Magical Self. Let's take a look at DVN, Devon, and EOG. So we looked at Devon. Did we look at it on Thursday? Devon Energy up 2.28%. Oil prices were on the move higher. I think there was a ship that was retained or okay. So please look at EOG resources. Okay, so sorry, I missed part of your question. So let's start with EOG. EOG. So these guys are, together with its subsidiaries, explores, Ford develops, produces, markets crude oil. Okay. This was formerly known as Enron Oil. Wow. Yeah. They wanted to change their name. So 59.9 billion, really low PE ratio. Dividend looks pretty good. Okay. And it's been sold off. Oil prices have not been all that great. Coming out of the COVID era when we had really low oil prices, but then they went up above $100 per barrel. Then since then, this stock, as well as others within energy, haven't done all that great. But that's not news to anybody. If you're in energy, you've known that. So EOG resources, that's where we're at there. Let's take a look at. So the revenue's been a little rough, and it's mainly because of the commodity price. The per barrel price has been down. Okay. 21 analysts cover it. and they think it's going to start growing and stay growing for a while. And the profits are really going to expand nicely. Okay. All right. So let me open up the valuation on Devon and see if we could do a valuation for EOG, and then we can compare the two. Okay, so here's Devon. We did that recently. We looked at it recently, I should say. Okay. So the free cash flow that EOG has produced in the trailing 12 months is 3 billion. $3,890,000,000. They're not going to grow by 10%. I'm going to go with 5. Looking at cash and debt. So they have $3,530,000,000 of cash, $8,130,000,000 of debt, 19% discount. If we look at the value based on the future cash flows that I estimate, and that's going to be trailing 12 months plus growth. And when we look at the forecast for the next year, what their earnings per share is going to be $10.65. And this is going to grow by like 12%. So there's a discount available. Now, it's not wildly different than Devon. And, which is going to perform better than another? I happen to think that natural gas producers, especially the producers that are near data centers, are going to do well. Whereas EOG, if they have Enron's assets, that was a big Texas company, and there's a lot of data centers opening in Texas. So let me take a look at their website. Yeah, they're down in Houston. So not a great website, but at least they have areas of operation. So you see all these reserves here. They're cranking out natural gas, especially in West Texas, the Permian Basin, and there's data centers that are popping up here, so they're going to consume a lot of that energy. Then they have the Appalachian Basin. Okay, so they have good assets, and what's good about this is they can get these resources to like the Cleveland area where they have a lot of refineries, and then they distribute out to the Northeast, which is where in the United States the highest concentration of population is in that region. So that's a very good place to have resources. So it's a very well positioned company. It's a good idea, but energy is only going to move based on the oil price. If oil price goes up, this stock's going to work. Oil prices go down, which I don't think they're going to go down much more because they're already low. It's not going to work, and it is going to pay a nice dividend in the meantime. So not a bad idea. Devon is also a good idea. It's discounted. Taking a look at Devon, it pays a dividend not as good. Its P ratio is a little better, discounted a little bit better, but overall, it's your pick. Like which one do you think is better positioned? I did like where their assets are located. This one did have assets in the right places. So I can't pick to one and say for sure, like Uber versus Lyft. I like Lyft. I mean, I like Uber. Excuse me. Got that one wrong. This one here, it's like, man, they're both. If oil prices go up, both are going to win. If you study the businesses, I would say EOG looks a little better because they have their reserves in really good markets. They're going to be able to sell their commodities quite fast and at low cost. So that does look good about them. So thanks for asking. Good to see you, magical self. All right. So that was EOG. Any last calls? Last calls on stocks before we conclude the stream. You're welcome, magical self. Good to see you. If you're not a member yet, consider being a member. With just the $100 per month membership, you can go on streams. Hey, can you look at the stock? And we're off to the races. Advanced member, you get to see advanced member videos I produce. I'm producing several per week. And you also get access to the valuation history that I keep. You get access to the model that I use. And I think a pretty good perk package. Super investors, you get invited to a member call, 3 member calls actually, and the Discord. Super investors, somebody who really wants more, and I just shared all my trades for the week as well as a full portfolio review with super investors. I shared it today before the stream, so you get access to that, as well as a 30-minute call each month. And this has been really well received, and I think people are getting a lot of value. If you have a big portfolio, really need a lot of research done, think about being a platinum investor, because you get to pick 3 stocks. I'll do videos, recordings, full analysis, and you get all the perks from the previous levels, by the way. So you could do calls and so forth. So if there's a level that's good for you, please consider it. And look at that. We got one more stock coming in. Let's take a look at PayPal. So considering slowly adding PayPal, and I have been dollar cost averaging into PayPal again. There's a lot of value here. The stock price is really low. It's been sold off and it just never really caught a rally. Now, they're doing good things. They're beginning to monetize Venmo, which is really a good idea. They have a stable coin. They've had it for a long time. That's great. Those are good things. And when we look at their growth, the growth is decent, especially the last quarter. 7.26 was good on a big number. So if they can just keep growing, keep getting more partnerships, keep making yourselves more involved in payment processing, crypto, stable coins, do more with Venmo, right? I think this stock can really work because it is discounted. Let's look at the forecast. Analysts think it's close to 30% discounted, 23 of them on average. And when we look at the forecast, they're going to keep growing. This is a decent growth number on a pretty big number, driving higher rates of profitability compared to revenue growth. So that looks great. And the PE ratio will get down to 7.96 unless the stock price rises. I think the stock price is going to rise. So overall, this is a discounted stock. And I decided to start adding some shares. It was a stock that I bought last week. 59% discount. So I'm a buyer of PayPal. And at some point, it's going to work. And if it keeps getting priced the way it is, I should accumulate more shares because eventually it's going to work. So that's my analysis on PayPal. Good luck with your decision. Good to see you, Big House. All right, so we covered that. One last item. You guys see me use stock analysis quite extensively, and I've been a subscriber, a full paid subscriber for a long time. This is a nice, clean website, and if you would like to be a subscriber of the website, which I get a lot of value from, you get more access to more years of history. Use a discount code that I'm going to provide on the stream, or I should say the chat, and you'll get 10% off. And yours truly will get credit as well, and I would appreciate it. So use this hyperlink and use the discount code VH Investing, and you'll get 10% off. So take a look at that, and let me see if I could open it. Yeah, here it is. So when you hit that link, you're going to go here. I think I'm a pro member. Yeah, I pay once a year, and I think I'm an unlimited member. And I've received a lot of value from this website. I think the people there have done a really nice job building it out, and I, to this point, have never received any benefit from them or monetary benefit from them. Now they've asked me to be, I guess, a spokesman and provide the links and so forth, and I'm happy to do so because I think it's a good tool. So you guys have seen me use it for years, and now you can get it 10% off. So think about it. All right. So everybody, thanks for tuning in on the weekend. Let's get rested up and get ready for Monday. I think we're going to have some sell days next week. So if you're looking to buy some shares and stocks, you might see the stock that you're interested in at a nice discount, and might be a good week to be ready to act. Do your homework, do your research, get your capital ready, and be ready to execute your trades. I know I'm going to be ready. I did my homework this morning. I went over my performance, doing good. And then I made that video for super investors showing all my trades and my portfolio. So I'm ready to go. Ready to go, stock market. Bring it. All right, guys. Oh, man, Atari Kid is back. Let's take a look. Good to see you, Atari Kid. So we're going to look at CDE, which is Coeur Mining. They operate as a gold and silver producer in the US, Canada, and Mexico. Okay. All right. So they operate mines trying to extract gold and silver. These guys have been doing quite well because gold prices have been going up. These guys are up to $143, 143% over the 1 year. Year to date looks even better. 5 year, gold wasn't doing much, but now it is. And judging from where we're at, right, we're going to have low interest rates. I don't know. I've never been a big gold guy, but let's just value this company on its fundamentals. And they just bought NGD. So let me open that up. NGD, New Gold. And these guys are Canadian. Okay. Okay. Okay, so their stock price has been doing well. $9.5 billion market cap, revenue of 1.7 billion, P ratio of 20, forward P of 12.27. Okay. And they're a little discounted. They've had a pretty good pullback in the last month. So is it a good time to buy? Let me take a peek at gold price, excuse me. So gold has been holding up. Man, look at that. Good looking chart. Yeah, gold prices are doing well and staying high. And I think there's a lot of risk, especially some of these high price stocks. I could totally understand investors selling out of these high price stocks and going into gold. That kind of makes sense. No, it's cool, Atari Kid. We can go do a full valuation here. All right, so these guys 1 year financials. The revenue's been going up. Looks good. Man, nice growth. So here's what I like to do with commodity companies. Okay, I'm looking at the annual, right? And you see that most definitely this year they're really growing. 24 they grew nicely. But other years they also grew quite nicely. And they had a couple red years, right? 2018 and then 2022. So overall it's been a really nice growth company. Okay, so that looks good. So let's jump into a valuation schedule. See what this one's going to look like when we just look at dollars, cash flows, earnings per share. So this company is a steel company. That's copper. BHP they do a little bit of gold. AMR, Freeport, steel, 3M. Okay. So we'll put them right next to BHP. Okay, so okay, so on the free cash flow, they're growing. So let me look at their free cash flow. So I'm going to go with the trailing 12 months free cash flow, and I'm going to grow by 5% because it's a little too ambitious to think, oh yeah, they're going to grow at 30% every year. I'll give them the benefit of, hey, you have a really good cash flow number this year. Good job. Let's see where you land on value. If you can sustain that kind of cash flow, what are you worth? And their cash on hand is 266 million. And their debt is 376. And their shares outstanding are not correct. So 642 million. So if we look at their free cash flow discounted by 9%, which is what I think is reasonable, growth rate of 5%. All right, so let's go with 6% on the growth. It's still, it's just priced up. I mean, the stock's been going up quite fast. Earnings per share, the valuation there. Let's take a look at the next year, $1.18. This is a pretty interesting space right now. So I'm going to go with 25, the growth rate. So it has a pretty good chance of rallying for a year. Let me show you what I'm looking at and kind of give you my theory. So if I believe their forecast, which I do, 10 analysts are contributing to it. Next year, 2026, they're going to grow at 37 and they're going to grow by 35. The stock's going to rally, but you have to have an exit strategy in the next year to 2 years. So make your decision accordingly. When we look at evaluation, most investors and analysts look at earnings per share, and they're going to be excited with where this stock's going. So this is a pretty good idea for somebody who wants to buy and have a hedge on what we're seeing out there. We're seeing really expensive stock prices. And the one place to go as a hedge is gold, and it's been doing great. Gold prices have stayed high, and this stock has pulled back. So it's looking pretty good. See this pullback? So that's where you're at. And if you're like a gold investor, if you like buying into gold, this is a good idea. If gold prices go up, this stock is going to go up for sure. If we have a big drop in gold prices, the opposite, but I don't think that's going to happen. Too many things are keeping gold higher. Inflation isn't completely gone. Asset prices keep going up. Gold prices are going to stay high. So that's CDE. Hopefully you found that interesting. What do you think, Atari Kid? I like what I'm seeing. Some of these gold stocks, when I look at them, they're just priced way too high. This one's not. So yeah, good luck with that one, Atari Kid. Let me know if you have any more questions. I'll keep the stream going in case you have any questions. And if anybody else has a stock you want to look at, let me know. We can take a look at it. I'm going to add this stock to the materials section of my watch list and pop it right in here. So CDE.
It's a double rainbow.
Cool. I'm on a stream. My wife just saw a double rainbow because it's raining in Southern California. She wanted to share it with me, which is cool. I'm glad she's taking pictures. All right, so got that one updated. So, question. Have you ever used leverage in a really down market? No, I have not. On stocks, right? So, no. I wouldn't ever recommend it. Leverage is super risky. It may pay off, but if it doesn't pay off, it could really cost you. I own my stocks and I'm good. Even I don't buy a lot of options, but some options, you're supposed to buy them on margin. And I just, through my broker, I put up the cash and never take leverage. Michael Anthony, I can look at DLO, $5 super chat, or become a member. Glad to look at DLO. Let me know. So new gold. Cool. This one looks good. All right, guys. So good stream today. Thanks for tuning in. Good luck next week. We're going to stream on Monday morning, Daryl and I, at 9 a.m. Eastern, 6 a.m. Pacific. So in between now and then, I'm going to kick out some new videos for members and look members for a couple videos to come out for advanced members. And we'll stream again on Monday. If you're a member and you want me to look at a particular stock on Monday, you could reach out to me on Discord, email, comment on a video, and then I'll put that stock that you want to look at on the list. So everybody enjoy the rest of your weekend. And let's see what we're going to do next week with these falling stocks. Take advantage of the opportunity, especially on companies that you really want to own. So that's it, everybody. Have a good night. Take care.